All right, let's go ahead and get started. So our topic last week was we learned how to do the accounting for accounts receivable. And remember why we would have an account receivable. We have sold something, we sold a product to a customer who said, thank you, I'll pay you later. Now, this week, we're kind of looking at that same transaction where we're selling goods to customers, but the account that we're focusing on is the inventory, the product that we sold to our customers. And when it comes to doing the accounting for inventory, the big thing, the thing that we're going to focus on tonight, is how do we calculate two amounts related to our inventory that appear on the financial statements. We need to be able to calculate the cost of goods sold, the expense that appears on the income statement. And we need to be able to calculate our ending inventory balance, the asset that appears on the balance sheet. And we have three acceptable ways, three different techniques that we can use to do those calculations, to come up with the inventory and cost of goods sold amounts. And I want you guys to recognize, I'd like for you to leave tonight understanding that each of these three techniques has the same objective or the same goal: to calculate our cost of goods sold and our inventory balance. How they achieve that goal differs between the different methods. They achieve it differently, but it is ultimately the same goal that they are after. And the way I would like to approach our work this evening is, let's talk about the first technique, and then we'll turn to our example and do a little bit of number crunching. Then we'll talk about the second technique, do a couple of calculations, and then wrap it up with the third technique and finish up our problem. The first method that we can use to calculate the cost of goods sold and ending inventory is called first in, first out. First in, first out. What you will hear called FIFO. FIFO stands for first in, first out. And let me tell you how FIFO works, but you want to remember what these methods are trying to accomplish. We've already said it already. They are trying to accomplish calculating two amounts that appear on the financial statements. The cost of goods sold is one of them. And using FIFO, the way it will calculate the cost of goods sold is FIFO assigns the oldest inventory costs. So it assigns your oldest inventory costs to the income statement, to cost of goods sold. So it is the oldest inventory cost that we've got that we will use to calculate our cost of goods sold under FIFO. But remember, these techniques are trying to calculate two amounts: the cost of goods sold and the ending inventory, the inventory balance that appears on our balance sheet. And if FIFO is assigning all of the oldest costs to cost of goods sold, that what's left is simply all of the newest costs for our ending inventory. So FIFO assigns the newest inventory costs. To the ending inventory balance. But I think by now, after 6 or 7 weeks of accounting, By now, we all know it is one thing to learn the words on a piece of paper. Anybody can learn it. It is a completely different ballgame to apply those words correctly to a problem. Let's see if we can do that. Can you guys please take a look at our example problem for this evening? And let's just read it together so we know what it says. It says that the following inventory information for ABC Company is given for the month of November. And you can see what we started with, and then all of the inventory that was purchased and sold during the year, or excuse me, during the month. It then tells us that ABC Company sells its inventory for $25 a unit. And during the month of November, they reported operating expenses, the rent and the utilities, salaries, that sort of thing. They reported operating expenses of $85,000 and had an income tax rate of 40%. And I've asked you to do 7 calculations. The first 2 relate to this FIFO method that we just talked about. In a minute, I'll ask maybe 1 or 2 of you to do a little bit of work. But before we get into requirements 1 and 2, there are 2 calculations I would like to do, 2 quick things that we will need in doing our work this evening. First thing I want to come up with: how many units did we actually sell in the month of November? So let's calculate the units sold in November. And I say, actually, this one's kind of an easy one, because it tells us in the problem where we had a sale, right? Sale, sale, sale. On November 10th, we sold 4,000 units. On November 20th, we sold 2,000 units. And on November 25th, 6,000 units. So during the month of November, a total of 12,000 units were sold to customers. That one wasn't so bad. The other calculation that I think we need to do before we can start actually answering the requirements. Let's figure out how many units we didn't sell. What do we still have left at the end of November? Let's calculate the units left unsold at November 30th, the end of the month. In here, I want to start, if I just jump back to that for a second, what I want to do is I want to take my beginning inventory, what I started with, and I want to add to that all of the units we purchased in the month of November. Let's do that. So we started with 3,000 units. We then purchased 4,500 units on November 7th, 6,300 units on November 14th, 5,600 units on November 22nd, and 4,000 units were purchased on November 29th. I think if you were to add all those up, that's going to give you 23,400 units. That's what we could have sold. That is the total amount we had available. But we know that we did not sell 23,400 units. What we sold were 12,000 units. So if we subtract what was sold, that'll tell me I have 11,400 units left in my ending inventory. Now, like I said, we're gonna need those numbers in doing our calculations for this evening. Are there any questions on what I did there before we move on? All right, let's see if we can handle FIFO. Take a look at requirement number 1. And it says, using the FIFO method, which is what we already talked about. Using the FIFO method, calculate the cost of goods sold for the month of November. I want to come up with my cost of goods sold. I'd like to give somebody a shot at doing this. Anybody want to try it? Give me the numbers to figure out your FIFO cost of goods sold. All right, Matthew. Excellent. Matthew, before you get started, can you answer one question for me, please? Tell me, how many units do we have to account for in cost of goods sold?
We have to account for 12,000.
That's why we did this. We didn't do these calculations for fun. We know that in November, 12,000 units were sold. So that's what we need to include here is our cost of goods sold. So let's note that this will include 12,000 units sold. Okay, Matthew, how are you going to do this calculation?
So since we're doing FIFO, we would essentially just start at the top and work our way down for the units until we reach 12,000 total.
Good. So agreed, 100%. So what are you going to start with? Give me the number of units.
So first you would record 3,000 units from November 1st for $6 per unit.
Good job. Can I get caught up?
Yep.
Here is what Matthew said. Here's what we wrote down just a few minutes ago. Using FIFO, it is the oldest inventory costs that we assign to cost of goods sold. So our cost of goods sold here is made up of all of the old costs, and the oldest inventory we've got would be what we started with, the 3,000 units at November 1st, each costing $6, which would be 18,000 assigned to cost of goods sold. Okay, Matthew, what's next?
So the next thing we would record is November 7th for 4,500 units at $10 per unit.
We go to the next oldest inventory, the purchase on November 7th. 4,500 units purchased that day at a cost of $10 each. So that 45,000 assigned to cost of goods sold. Good job. Matthew, another quick question here. Are we done yet?
No, we are not.
Why not?
We still need to record 4,500 more units.
And why 4,500 more?
Because I took 12,000 and then you take out the first 3,000 and the next 4,500 and it just leaves you with that much.
Because you got to get to that number, right?
Yeah.
Yeah, absolutely. You're absolutely right. We got to get 12,000 units. So far, he has only accounted for 7,500 units. So he needs, as he said, another 4,500. Where are you going to get those units from, Matthew?
So you would record November 14th, but only for the 4,500 you sold at $3 per.
Excellent, excellent job. Matthew, you can mute your microphone, but that is outstanding. Good start to the work this evening. So we go to our next oldest inventory purchase, that on November 14th. Now, on that day, we bought 6,300 units, but I don't want all 6,300 over here because that would take me above 12,000. I got to have 12,000. So of those 6,300, we will take 4,500 of them. Each of those units costs $3. So that is 13,500. And our cost of goods sold here under FIFO, which consists of 12,000 units, has a total cost of $76,500. All right, outstanding job, Matthew. Great work. Before we move on, are there any questions on any of his work here? Please ask, because inventory calculations are going to be a big deal come exam 2. So you want to make sure you can handle it. Any questions on the work there? Alex, go ahead.
Where did we get the 12,000 units sold?
So we had calculated here in the month
Okay,
of November,
gotcha.
we sold 12,000 units. And that was just, you could find that wherever it told you there was a sale.
Gotcha. Thank you.
Well, any other questions? All right, take a look at requirement number 2. Still using FIFO. I've now asked you to calculate our ending inventory balance. So we're still working with FIFO here. But now I want to come up with my ending inventory. Do I have a new volunteer, a new voice, to do a little bit of work in calculating our ending inventory? Anybody want to take this? All right, I'll do this one, but I'm gonna make sure you guys do a little work on the next technique. Here's what I know. Now, Matthew, he told us that the cost of goods sold was based on the 12,000 units that we sold. The ending inventory, however, is based on what we have left. We have to account in our ending inventory for 11,400 units we didn't sell. 11,400 units left in our ending inventory. And under FIFO, what did we write here? It is the newest inventory costs that we assign to our ending inventory. And the newest costs, the most recent purchase, is all the way down here at the bottom. The 4,000 units purchased on November 29th. So I will take those 4,000 units each costing $6.60. And that $26,400 assigned to our ending inventory. But we're not done, because we have to account for 11,400 units. So far, I've only got 4,000. So I go to my next newest inventory, the purchase on November 22nd, where I will take those 5,600 units, each costing $12. And that total cost of 67,200 assigned to our ending inventory. And I say, I'm still not done yet. I need 11,400 units. What is that right there? I have got what, 9,600? I still need 1,800 more. So I go to the next newest purchase, going right up the problem, November 14th. And I will take 1,800 of those units. I only take 1,800 of them because that gets me to the 11,400 units that are in our ending inventory. And those 1,800 units each cost $3. That's $5,400. And using FIFO, our ending inventory total cost $99,000. Are there any questions on anything we did there in applying the FIFO method? Well, then let's talk about our second technique. The second way we have of doing this calculation, of coming up with the cost of goods sold and the ending inventory amounts. And that second technique is called weighted average. So let's talk for a few minutes about this weighted average method. And the way that weighted average works, weighted average is going to, just as the name kind of implies, calculate an average cost and then use that to assign to all of our units. So in other words, this technique assigns the same unit cost to everything, to both cost of goods sold and to ending inventory. I think we should write that. So this method assigns the same unit cost to both cost of goods sold and to ending inventory. In other words, what we are saying is that we're going to assume everything costs the same. Whether the units were sold or not, doesn't matter. Everything has the same cost. And the real work here, the real work in applying weighted average, is calculating that what we call same unit cost. And we call that our weighted average cost per unit. And let me give you the equation to calculate your weighted average cost per unit. You'll calculate the weighted average cost per unit by taking your total inventory cost, which would be the cost of your beginning inventory and then we add to that the cost of our purchases. The cost of beginning plus the cost of purchases. And if you guys don't mind, just one quick question. I'll take anybody. Can somebody just answer for me? What do we call this? What's the name that we give to the beginning inventory plus our purchases? What's the name to that? Matthew, what do we call that?
Is that the cost of goods available for sale?
Yeah, very good. Good job. The cost of goods available for sale, the cost of goods we would have been able to sell to our customers. So we'll take that cost of goods available for sale and divide it by the number of units that are available for sale. The units in our beginning inventory plus the units that we purchased. And the good news is all of those numbers we've got given to us in the problem. If you guys look here for a second, the inventory information is here. And this very last column gives us the cost of the inventory. And then this column right here gives us the number of units. So when I look at my beginning inventory, the cost was $18,000. Then we'll add to that all of the costs of purchasing inventory. So we'll add 45,000, 18,900, 67,200, and 26,400. We'll divide that by all of the units that we had available. There were 3,000 units in the beginning inventory, plus all of the units we purchased. 4,500 purchased on November 7th, 6,300 on November 14th, 5,600 on November 22nd, and 4,000 units purchased on November 29th. So when you add all this stuff up, what we have, cost of goods available for sale, 175,500 divided by the units available for sale, 23,400, giving us a weighted average cost per unit of $7.50. What we're saying is every unit we've got, we will assign a cost of $7.50 to. Now, before I take this page away and we do requirements 3 and 4 of the problem, are there any questions? You got to be able to do that. You can't, and you can't apply weighted average. Any questions on what I did there? Take a look at requirement number 3. Using the weighted average method, coming up or following the weighted average approach, we want to use weighted average here. Calculate our ending inventory balance. I'll start by asking for a volunteer. Can somebody give me the numbers to come up with the ending inventory using weighted average? Chloe, excellent. Your microphone's on. Chloe, how will you do this calculation?
You would take 11,400 times $7.50.
Chloe, how easy is that, right? Weighted average is no big deal. Great job. You can mute your microphone. We know that our ending inventory consists of 11,400 units that we did not sell. And under weighted average, we are assigning each of those units a cost of $7.50. So to get our ending inventory, take the 11,400 units we had left times the weighted average cost per unit, $7.50. And that would give us an ending inventory amount of $85,500 when applying the weighted average approach. All right, Chloe, good job. Well done. Any questions on number 3? We'll take a look at number 4 then. This one might be just a shade tougher. Requirement number 4 wants us to calculate ABC Company's gross profit for the month of November using this weighted average method. Here's my question. I want to hear a new voice, please. So I'll start again by asking for a volunteer. Can you give me the basic equation that we use to calculate gross profit? How do you calculate gross profit? Dominic Porter, can you please turn your microphone on for a moment? Dominic,
Yeah.
can you tell me, how do you calculate gross profit?
The net income minus cost of goods sold.
Oh, Dominic, you're close. We got to fix something there. I don't think it's the net income, but I do like the minus the cost of goods sold. Let's see here. Alex Norwood. Alex, your microphone turned on. Alex,
Yeah, isn't it revenue minus cost of goods sold?
can you be, Alex, you're getting closer. Can you be a tad more specific? What type of revenue?
Sales.
Chris, very good. Chris, keep the microphone on. I'm going to ask you a question. But you're absolutely right. To calculate our gross profit, let's put this equation up. To come up with our gross profit, it is the sales revenue minus the cost of goods sold. Okay, Chris, that means in order for us to answer requirement 4, we got to come up with the sales revenue and we got to come up with the cost of goods sold. Are you able to give me numbers from the problem to calculate your sales revenue?
Yes.
What are they going to be?
On November 10th, a sale for 4,000 units. Oh, I guess we don't have price, so oh yeah, we do 25 per unit.
Keep going.
And then it would be a sale on November 20th, 2,000 units. At $25 a unit, and then
Continue.
a sale on the 25th.
So Chris, you're absolutely right. And what we know, we calculated this a little bit ago, is in the month of November, we sold, those were the three amounts you gave me, right? The 10th, the 20th, 25th. We sold a total of 12,000 units. And just like he said, they told us in this problem, ABC company sells inventory to customers for a price of 25 bucks each. So we can calculate our sales revenue as the 12,000 units that we sold times $25. Chris, how would you calculate your cost of goods sold? Using the weighted average method, how are we going to come up with our cost of goods sold?
So I know like the basic principle, I just can't do it at the moment.
That's all right. Go ahead and mute your microphone. Can somebody help him out, please? How do you calculate using weighted average the cost of goods sold in our problem? Any takers? Matthew, I'm hearing from you a lot tonight, but that's good. Tell me how to calculate cost of goods sold.
So you would take the units sold, which is 12,000, multiplied by the weight average per unit of $7.50.
Sounds like an answer to me. Good job, Matthew. Well done. We know, right? Isn't this what Chloe did right here? To get the ending inventory, she took the units that we didn't sell times the weighted average cost per unit. So to get our cost of goods sold, we'll take what we did sell, 12,000 units, times the weighted average cost per unit of $7.50. Giving me a cost of, giving me a sales revenue of 300,000 and a cost of goods sold under weighted average 90,000. So we can calculate our gross profit. It's the sales revenue 300,000 minus the cost of goods sold 90,000, which would be a total of $210,000. I thought number 4 was a good calculation. Any questions on any of the work that we've done to this point? So then here's what you guys have seen. We now know how to apply FIFO and do the FIFO calculations. We know how to apply weighted average and do the weighted average calculations. The third technique that we need to talk about is called last in, first out. What you will hear called LIFO. Last in, first out, LIFO, LIFO. And let me tell you a little bit about how LIFO works. if you understood FIFO, you almost can't help but understand LIFO because it is literally the exact opposite. Whereas FIFO assigned the oldest inventory costs to cost of goods sold, LIFO assigns the newest ones, exact opposite. So this technique assigns the newest inventory costs. To our cost of goods sold. And whereas FIFO assigns the newest cost to ending inventory, LIFO does the opposite. So it assigns the oldest costs to our ending inventory. It assigns the oldest inventory costs to ending inventory. And that is what they have asked for in requirement 5 of the problem. They want us to use the LIFO method and calculate the ending inventory balance. Now, I have just one quick question. I would like to hear from one quick question. Can I please hear from, how about Connor Moore? Connor, would you please turn your microphone off for just a moment? Connor, are you present with us? All right, Connor, very good. Connor, can you tell me just one real quick? So they've asked us to calculate the ending inventory using LIFO. In fact, let me get this sort of set up here, Connor. So we're using LIFO. And they've asked for the ending inventory. My question, Connor, is this: how many units would we need to account for in ending inventory? How many units make up our ending inventory? Connor, your microphone's muted again. So if you unmute it, just tell me how many units we have to deal with. See if I can push it just a little bit.
Yeah, was it be the same thing?
How many units?
11,400.
That didn't change. That is what we have left in our ending inventory. That is what we have to account for. And so we didn't do these again. We didn't come up with those for fun. We need them. We've used them a lot this evening. So we know that our ending inventory consists of 11,400 units that we didn't sell. But under LIFO, the ending inventory is made up of the oldest inventory costs. Connor, if you don't mind, just microphone on for one more quick second, please. Connor, in our problem, what would be the oldest inventory cost that we've got?
It would be on November 7th.
What's even older than November 7th?
Oh, the beginning inventory would be the first, yeah.
What we started with. We started with the 3,000 units. That's our oldest inventory. So that's what we're going to start assigning to our cost of goods sold. Connor, good. I'm going to have one more question for you in just a moment. So I'm going to take those 3,000 units from the beginning inventory, each costing $6. And that would give me a cost of 18,000 assigned to our ending inventory. I then say, well, okay, I go to the next oldest inventory, and that would be the purchase on November 7th. Now we're that purchase. Take those 4,500 units. Each costing $10. And that 45,000 assigned to ending inventory. Connor, here's my last question to you. Please turn the mic on one more time. So Connor, I now go to my next oldest inventory. The purchase on November 14th. Just a yes or no question. Do I take all 6,300 units and put them here?
I would say yeah.
Connor, can I, if you don't mind, if I can ask one more question? If I were to take all 6,300 units, that would give
Put
me
you over.
Oh, say that again.
It would put you over that total at the end.
Good, wouldn't it? We would
Yeah.
go over the 11,400. So I'm going to back up, answer this question again. Yes or no? Do we
No,
take
you wouldn't.
all 6,300 units?
No.
Definitely not, because of exactly what you just said. If I take all 6,300 units, then that's going to put me over that total. We can't do that. All right, Connor, good job. You can mute your microphone. So we've got to stop at 11,400, right? So we need 11,400. Right now, I've got 7,500 units. I still need 3,900 units from the November 14th purchase, each costing $3, which is 11,700. I took 3,900 units because that got me to the 11,400 units I need. And under LIFO, my ending inventory, $74,700. Are there, and again, these are calculations you definitely have to be able to do. Are there any questions on any of that work there? Okay, I'm gonna do one more calculation, and then I'd like to maybe see if I can get a new voice to do requirement 6. Let me do one thing. Let's use LIFO, and let's calculate our cost of goods sold. We want to use LIFO. And let's come up with our cost of goods sold. And I know that in my cost of goods sold, I have to account for 12,000 units sold. That's what we sold to customers. That's the total we have to get to. So our cost of goods sold, we need to account for 12,000 units. I also know under LIFO that the cost of goods sold is made up of the newest inventory costs. So if I look in our problem, the newest costs are the most recent purchases. So the purchase that we made on November 29th. Take those 4,000 units, each costing $6.60. And we will assign that $26,400 to the cost of goods sold. But we're not done, right? We got to account for 12,000. So I go to my next newest purchase. The purchase on November 22nd of 5,600 units. So I'll take those 5,600 units, each costing $12. 67,200. And I know I'm still not done because I haven't reached 12,000 units yet, right? What we got here is what, 9,600? So I go to my next newest inventory, the purchase here on November 14th. But just like Connor said, when he did the ending inventory, he didn't want to take all 6,300 units because that was going to take him over the total. Well, same thing here. If I take all 6,300 units, I go well above the 12,000 units that we have to account for. In fact, I can, what is it I need? I got 9,600 here, so I only need 2,400 more. Because that will get me to the 12,000 units that have to be accounted for. And those 2,400 units from November 14th each cost $3. That's 7,200 here. Under LIFO, our cost of goods sold, $100,800. We're going to need that in requirement 6. Before we tackle it, any questions on what I did there? Okay. I'd love to get a new voice if I can. A volunteer. Requirement number 6, using LIFO, calculate ABC Company's net income for the month of November. Does somebody want to give that a shot? How to calculate net income. Revenues minus expenses. And I can calculate my sales revenue. Because I know that we sold 12,000 units. And we sold them for a price, a selling price of $25 each. Which gave us sales revenue of $300,000. We also know, because we've done income statements before, that we then subtract the cost of goods sold, which we just calculated. $100,800. When I do the subtraction, I've got 199,200 here. And I also know that sales revenue minus cost of goods sold is called our gross profit. Which is not net income. I still have to subtract my other expenses. And they told us in the problem during November, ABC Company had operating expenses of $85,000. So we'll subtract the operating expenses, 85,000. And that will give me here 114,200. But I have to recognize I have still not yet accounted for our taxes. All the problem says is we had an income tax rate of 40%. So let's call this 114,200 our income before tax. We still have to subtract the income tax expense. So we can get down to net income. And the reason I want you to lay out your income statement this way is the income tax expense, it is not based on your sales revenue, and it is not based on your gross profit. We'll calculate the income tax expense based on that number right there, the income before tax. So take that 114,200 multiplied by the tax rate given as 40%. And we have income tax expense of 45,680, resulting in a net income 68,520. I think that's a pretty good calculation. Any questions on what I did there? The last thing they ask us to figure out in number 7 is one of the ratios that we learned, the inventory turnover ratio for the month of November using the LIFO method. And you'll calculate your inventory turnover by taking your cost of goods sold and dividing it by your average inventory. The cost of goods sold over average inventory. And they specifically stated in this requirement to do the calculation using LIFO. And just a few minutes ago, using LIFO, we calculated our cost of goods sold, $100,800. And we saw last week, right, when we did the accounts receivable turnover, that anytime you have an average, that is calculated as your beginning plus ending divided by 2. Now, please look at our problem for a minute. You guys see the beginning inventory? Cost of $18,000. So I'll take that 18,000. Using LIFO, we calculated the ending inventory, 74,000. 700. So we'll take the beginning inventory plus the ending inventory, divide that by 2. That way we get an average inventory. 100,800 divide by our average inventory, 46,350. Gives me an inventory turnover ratio of approximately 2.17. Are there any questions on any of the calculations, any of the work that we did here in our problem together this evening? All right, guys, that is what don't forget, quiz 3 is due Thursday.